Hey kids, how's it going? It's Mr. Hession. I'm just hoping that you're healthy, happy, and safe. Uh, so what we're looking at today is the beginning of what is called the Great Depression with the stock market crash. So I just want to make something very, very clear. When you're looking at the Great Depression, the stock market crashing was not the cause of the Great Depression as a whole economic system. It started the downward spiral that would lead to the Great Depression. But if you look at the economic charts from when the stock market crashed late in 1929 through the 1930s, you saw the stock market go up, it went down, went up, and then it came tumbling down in the early 30s, like 1932 33 is when it was at the height of the worst of it. So stock market crashing did not lead to the immediate destruction of the American economic system as they knew it. But we could look at the causes as for the stock market crash and the loss of a tremendous amount of wealth. So I attached a PowerPoint that I'm just going to kind of go over a little bit. So if you have any questions today, please just post it in the comments and I'll take a look at them later. So part of the problems that the stock market had big issues late for stock market crash, there was a lot of risky investments. And what a lot of people did, they would use credit to purchase stocks. So, for example, if I wanted to buy Amazon stocks, and you're not going to buy one Amazon stock, you're going to buy 100, 200 to make your investment worth it. Well, I don't exactly have, 20 grand, 30, 40 grand laying around to invest. So I could go out, take a loan, and invest it with some principal, my down payment, my cash up front. And over time, I'm paying off my loan, hopefully while Amazon is stock is rising. So when the stock goes up, awesome. I am now making money. When the stock goes down, I'm not necessarily losing money at that moment. The only time someone loses money in the stock market is when they turn around and try to sell the stock at a lower price than they when they bought it. So if I were to buy Coca-Cola, let's just say it's at $50, it's higher, but at $50. So I invest $50, goes up to 52. Okay, great. For every share that I bought, I made $2. But did I really make $2? No, I didn't because I didn't sell anything. Conversely, if I buy it at $50, it goes down to 48. Oh no, I lost $2. No, no, I did not lose $2. I did not. It's just my investment, its return so far has gone down. Hopefully, that over the next years, it will go above 50. And if you look at the stock market chart from its very beginnings, it has a history of climbing. So people were not able to sell their stocks at a profit to pay back their loans. So that's why the credit system had a very big problem. So on Black Tuesday, October 29th, that's when the stock market crashed. So also we talk about the 1920s, how like we saw kind of like a consumer revolution where people were buying more products than they ever did. They were people thought like the good times were always going to keep rolling. So there was minimal saving. People were getting to debt with credit. Businesses were producing a lot of products, but nobody was buying products. Uh, and the government never had any regulation to control businesses and protect assets in the stock market, etc. We're going to get into where we are, such as the SEC, Security Exchange Commission. Uh, Banks, there was no FDIC, where if a bank goes out of business, people literally lost their money. And if you were to ask your parents about their grandparents, many of them would literally keep money in the mattress because they felt that their money was safer under a mattress than in a bank. Today, I would strongly advise people to keep their money in, say, a bank because you're investing that money into the economy. You are potentially making interest, so it's making money, and you do have access to it. So, a lot of people started taking their money out of banks because they didn't trust banks anymore. So then, what's a bank without money? It's done because banks will take the money that you put into a savings account and give Johnny a loan for a car, Molly B a loan for a house, and a sign of a good economy is when money is constantly moving, passing hands. Okay, that is when the economy is going very, very well. So, like right now, we are struggling, and economically, we're taking a big hit because people aren't spending as much money. People are losing their jobs. So, people who have lost jobs, they're not really spending money. So, passing of money has come to a snail's pace almost. So, the key to any good economy is when people are spending money, banks are giving loans, people are paying back those loans, and we see investment in human capital, meaning hiring people. So we are looking at uh, the Great Depression, and if you go through the charts, you see like today we have people say, "Oh, President Trump do this, President Trump do that, President Trump, and Governor Cuomo, Mayor De Blasio." Like, so back in 1929, President Hoover was like, not going to do anything. That's not the government's job. The idea of a bailout was the furthest from any president's mind. We have the retrospect of history because when they saw the Great Depression as it was unfolding, they're like, oh, this happened before. Recessions, depressions, they happen. It's cyclical. President Hoover is like, okay, we're going to get through this. It's going to be fine. However, the difference between this depression and other depressions that we saw in the 1800s is that it really did impact not just large scale businesses, but people who were greatly in debt, and also the financial systems was crushed. So the what made the Great Depression was the lack of credit. Now, credit has the ability to build an empire, has the ability to build wealth, to create generational wealth. Credit will enable you to buy a car, to buy a home, buy a jet ski, whatever you want, and you'll just pay it back later. However, the lack of credit stops businesses from opening. It stops people from being able to make large scale purchases. Credit is single handedly the most important fundamental aspect of our financial system. And when that goes away, it's game over, which is why a lot of people are turning to the government. They are turning to the president, the governor for financial relief, looking towards the banks for forgiveness of loans or at least temporary hold on loans so that the credit system can continue. So President Hoover does nothing. And again, like if he probably looked at the history books like, oh, the president didn't do anything, it turned out fine. Unfortunately, he was making history, and the history book said he didn't do that good of a job. So we see factories shut down, farmers struggle, businesses going out of business. So therefore, more people getting laid off, schools shutting down, families becoming homeless, and the pictures are devastating. And a lot of what they would call Hoovervilles began to spring up, and they were an ode to President Hoover. Now, these were shanty towns, people living in shacks, some even developed in Central Park. And people lived in awful conditions, but they had nowhere else to go. So those beautiful cars that they bought in the 1920s became their de facto homes. So the Roaring Twenties end on a very low note, and a lot of iconic pictures um, that I posted there. So we're looking at the Great Depression over the next couple of weeks, um, and the government response to it. The reason why there are bailouts on the table, why stimulus checks have been issued, are from the lessons that we learned from the Great Depression. So we are in history right now, we're witnessing history right now, but we're also paying attention to what government did almost 100 years ago to combat the effects of the Great Depression. So again, if you have any questions, please put them in the comments in the class stream. I'll get back to you. And again, hope you're staying happy, healthy, and safe. All right, be well, kids.